Is private credit systemically risky? That's what I'm going to try and answer in this video, because there's a lot of people saying that it is, and they are in positions of authority and respect. They're central bankers and regulators and investment bank CEOs. So you'd think they know what they're talking about. But in this video, I'm going to try to get to the bottom of what's really going on. One of the most interesting things and attractive things, I think, about private markets in general isn't so much the return that you can get. So there's this endless debate about how much more return you get in private markets versus public and whether it's really worth the hassle. But for me, the interesting thing isn't so much the return as the risk. Everyone assumes that because you get a higher return in private markets, you're taking on a higher risk. It's the classic efficient markets, efficient frontier. But that's not the case at all. Private markets are demonstrably lower risk. Even in the worst years and the worst downturns, private market returns far exceed public markets. But the reason for that is that private markets ownership model, as the fund structure, is very conducive to managing what they call idiosyncratic risk. So the risk of individual companies and credits. It's really good at managing that from a bottom-up perspective. So it's highly unlikely you're going to lose all your money in a well-diversified, exceptionally unlikely you're going to lose your money in a well-diversified private markets portfolio for that reason. So that's the management of idiosyncratic risk. This video, though, is about whether there's systemic risk in private credit. So whether private credit poses a risk to the financial system itself. But before we go there, let me just explain very quickly what private credit essentially is. A bunch of people get together, and when I say people, it can be people, individual investors, more often pension funds, insurance companies, and they put their money in a fund, which is managed by a fund manager that then invests that money in companies by lending to them private credit, right, and getting the money back. It's simple. I think most people assume that's how it's kind of always been done to an extent. But no, that this is actually a recent phenomenon. And the reason for that is that this market of lending to companies, to private companies in particular, has been monopolized by a cartel. And that cartel is the regulated banking industry. But that's not how banks lend to companies. What banks do is that they don't raise money from people in order to lend. They take in deposits. And most people will think, well, my deposit's in the bank. It might not be in a vault, but maybe it's in the digital equivalent of a vault. But that's obviously, if you know anything about banking, you'll know that that's not the case at all. They take that money and they take a tiny slice of it as collateral, and they create a whole load of new money and then lend that out. So banks are inherently incredibly highly leveraged. Now, since the global financial crisis, their leverage ratios have gone down, but fractional reserve banking remains a Ponzi scheme effectively. But it's even worse than that, because the assets that they have are short term. They're like overnight deposits, whereas they make long-term loans, right? And so that's called maturity transformation in the lingo, but it basically means that you've got short-term assets, long-term liabilities, and you've got a timing problem. This creates real systemic risk, and this is why banks have to be regulated. After the global financial crisis, regulators realized actually this system is too risky, so they introduced regulation like Dodd-Frank in 2010, which made it more expensive for banks to lend. And so filling the gap, this private sector initiative came in, private credit funds, to fill that gap and provide that credit to companies. And so the irony here is that you've got private credit funds that are taking money from consenting adults and from institutions. They're taking their actual money, their equity, and they're investing it as credit at risk. And that's referred to as a non-bank or a shadow bank, whereas that's exactly what a bank should do. In the classic Austrian economics conception of a free bank or a 100% reserve bank, that's exactly what private credit funds are. They are banks, whereas the regulated banking industry, that's shadow banking, because that's the mysterious world of money creation and of maturity transformation. That's murky, that's opaque. And so if that's the case, you must be wondering, well, why are the regulators so worried about private credit? My answer to that is that regulators are people. So you think as regulators what they care about is systemic risk, but as people actually what they care about is power. And they don't like the fact that private credit isn't regulated. It's not part of their domain. They want to bring it within the fold. And they feel that regulated banking markets, they're transparent because they're regulated. And private credit, that's opaque. But private credit is only opaque to them. It's not opaque to the people taking the risk. So private credit, if you extend a loan as a private credit fund manager, you do your due diligence on that specific company and you tailor that debt package to that specific company. It's not a standardized publicly tradable debt security like a leveraged loan or a bond is. Private credit is different. And that means you do deep due diligence. Due diligence is just a legal term, meaning you do your homework on who you're lending your money to make sure that they're going to be able to pay it back. I mean, it's pretty basic stuff. But that's why private markets are much less risky than their public market equivalents, and why you get a better return, right? So that's banking, that's not shadow banking. And the irony we've got here is that central bankers, the ones that we're paying to manage the risk, they're actually creating risk, right? So Andrew Bailey, for example, he's been a very prominent critic of private credit. He's the governor of the Bank of England, and he recently likened private credit to the subprime mortgage crisis in the US, just at the point of the global financial crisis. And he said, we've seen this movie before. But if he has seen that movie, I don't think he understood the plot. And he certainly didn't realize who the villain was, because the villain of the global financial crisis was precisely the central planners and the central bankers that manipulated the money supply and created this malinvestment and these false incentives. And then we have Jamie Dimon, who's the CEO of JP Morgan. In 2025, there were two spectacular private credit write-offs. I think they were called Tricolor and First State or something like that. So he made a massive deal of this because Jamie Dimon, he's an intermediary, he's a banker. Intermediaries, they're the people that you want to try and cut out. That's called progress when you cut out an intermediary. So private credit cuts out the intermediary because asset managers originate these loans and they lend directly. They don't need the whole apparatus of the banking world, really. Not for that part of it anyway. Jamie Dimon, he can't stand them. And so he says, right, well, there have been two failures and bad credits are like cockroaches, i.e., he's pointing towards a systemic risk, right? If you see two bad ones, there are plenty more under the carpet, right? But what he doesn't tend to point out is that was at the part of the private credit market that is originated by banks, not by private credit funds. And so those two bad credits, the two of 2025, they had nothing to do with the private credit fund management world. So these are the people claiming that private credit is systemically risky. And the whole thing, I think, is a kind of slander. Because it's not a conservative thing to say that something is more risky than it is, even if you are like a regulator, because this is the risk business. And so if you overstate risk, you are creating risk in the system as a regulator. So they're doing a very bad thing here. And that's why I wanted to make this video. I'm not telling you to invest in private credit. I'm not telling you to do anything. What I am saying, though, is that private credit is not a source of systemic risk.